regulatory risk.
Okay.
Yeah, they're basically saying that the increase uh, in uncertainty due to policy, that partnering becomes more important because a partnering strategy de-risks both the development costs, commercialization in the face of multi-year policy uncertainty. That's sort of a nice politically correct way to say what the country is facing in all levels. Multi-year policy uncertainty.
Well, is the regulatory, I'll go into mine in a second, but since you started there, is the regulatory uncertainty affecting the way you're investing?
No, but the multi-year policy uncertainty certainly has affected the way that I'm investing. I'm investing in far fewer. I'm spending much less time looking at biotech, more time looking since I've added to commodities, gold stocks and silver stocks, uranium over the last 2 years. I'm spending more time starting to look at like junior gold stocks now, so on and so forth, and investing in assets that are not denominated in US dollars. So,
That's
so I've
Jose is
gotten
nodding
away.
his head.
So
Yeah, that's what I have actually. Yeah. I
yeah,
like
I've gotten away from biotech because it's not just so this policy uncertainty that they're talking about, it's also if you look in the chemical industry writ larger, like large chemical companies, when I listen to the ACS seminars, they say no one's making investments because they don't know what the rules of the road are going to be. You know, like to build a chemical plant takes a lot of money, multiple years. And you have China as it is, skewing the market with excess capacity. Now, on top of that, when you layer in policy uncertainty, trade uncertainty, they're just not going to make large investments, large long-term investments. So, yeah,
Um,
yeah.
I echo what you're saying before I get to it, Tom, TM, Jose, we were saying Eliska, her name on in chat is PF Capital, who you might have seen her post on quite a few names, but we've never put a face to a username. So now you know for the future.
that's
So welcome
awesome.
aboard.
Welcome. Good to meet
Uh,
you.
Thank you.
Aliska, how long have you been with I remember your post for a number of years now, correct?
I think it's about a year in
Mhm.
ROTY, maybe a little
Okay.
bit more.
Okay. Before I move on to your favorite playing ground, is it more late stage clinical or commercial or turnarounds or the names you were posting on?
So kind of like micro and small caps.
Hmm.
I mean, it's quite a like big range, but I like the companies to have at least some clinical data.
Hmm.
But I also invest into commercial, but early stage commercial.
Early launches. Yeah, those
Yeah,
are
yeah.
fun when you find those ones with like good metrics out of the gate before they're being given much credit. It's nice.
I actually the way I came across ROTY was we had a huge overlap in the portfolio, and then I felt like that's the community I really have to be part of, because like even
Mhm.
like before I started following you and I started reading what all of you are commenting, like I already was looking at the same companies, so it just really made sense for me.
Hey, cheers. Um,
Where are
Jack,
you
going to it.
located?
Go ahead, Tom.
Eliska, where are you located?
I'm in Prague, so I'm connecting from Prague, Czech Republic.
Oh,
Okay,
it's closer.
awesome.
Closer to
Oh,
Jose's neck of the woods.
It's not, yeah, not that far. And I heard Prague is beautiful.
so where are you again?
I'm in Switzerland.
Oh, Switzerland. Okay.
Yeah, in Bern.
Well,
Yeah.
probably just next door compared to everyone else in the chat.
And my brother just moved to Oberstdorf with his family. Him and his wife are doctors, three kids, and they moved to Germany right next to the border of Austria. So now I have an
Okay, very
excuse every
nice.
year to go visit him. Going back to what you were saying, Jack, it's funny. I haven't used LinkedIn for the longest time, like 8 years or something, because back when I first started writing on Seeking Alpha, They do a lot better job now of regulating the writers, but before there would be like a lot of unsavory, whether it's characters or IR teams, investor relations that would reach out to us on LinkedIn, like the writers, and ask us to write stuff for them. So I got so tired of the requests that I just deleted my LinkedIn. But more recently, I started using it again every so often. And one of the fund managers, I'm forgetting which fund it was in biotech, it's a bigger one. He was commenting on all the tailwinds for commercial stage biotech for many of the reasons you were saying, Jack. And he's like, there's so much good visibility here that this is where you want to be the next 10 years. And that was kind of nice to read that because that's kind of where we are right now and focusing on a lot. I think right now the portfolio's 17% clinical or something like that. So definitely affecting the way we're investing right now. Wassim, I see you can make it too while you're raising your little biotech investor at home.
Yes, hi there. It's been a challenging couple of weeks, but I'm glad they've made it alive, and I'm glad I'm here again. Enjoying your company. So thanks
Hey,
for
cheers,
the
man.
best wish. Thanks for the good wishes.
Yeah, Wassim, congrats. I'm very happy for you.
Thank you. Thanks, man. It's amazing to be a dad. I cannot emphasize how beautiful it is to, maybe see yourself in another human being. It's kind of crazy.
Does the baby have any pics? Anything recommending that we should be buying?
I think she's the kind of person that likes black sheep as well. So I'll let you know.
So
Uh-oh, you're in for trouble.
she's gonna come with you when you go visit Tom at his vineyard.
That's
I
for
like it.
sure.
Tom and I had a very last minute meetup in Marietta where he stopped by. He was already in Atlanta. So I have a case of wine from Tom I got to start working on. But it was nice meeting up, especially those last minute ROTY meetups. So hopefully we'll see more of those this year. Do I have it right, Tom? You're still offering the vineyard for a full member meetup, whoever wants to go?
Sure, Jack. We'll all get together and we'll have fun. We had a really good one right before COVID, where I got a group together out in Pennsylvania. We met at a pizza restaurant, and we had. That's where I met
Was that
Menzies.
Michael Meltzer?
Yeah, Michael was there, Manziel was there, a couple other folks who've kind of come and gone, but we had a good time. It was interesting. Yeah, no, it was a lot of fun. It's always fun to meet everybody, but the Zoom calls here are great because you kind of get to do that without traveling. We just need to figure out how to have the pizza.
I like it. One thing that Wasim mentioned to me that was really cool. I haven't got around to it yet, but it would be cool to do like one-on-one interviews, like just a Zoom call talking only with veteran ROTY members or people who want to, share their strategy, maybe that light bulb moment where you went from starting out in the sector to starting to rack up a few wins and being like, oh, I can do this, because at least for me, starting out in the sector, I felt so far behind with my lack of knowledge in biotech and healthcare. And it took so long to actually get to the point where you're getting consistent wins versus that feeling of one step forward, two steps back. You have a big win, then you give it all back, rinse and repeat. So it's nice to hear how each person kind of found what worked for them. How long did it take? My learning curve was unnecessarily really, really long because I'm very stubborn and slow to turn mistakes into rules. But the hope is, I'm sure for others, it was hopefully a little bit faster.
Well, you've got the squirrels down to 17%, so you're learning.
I'm trying, man. An interesting thing, like a light bulb moment for me recently, like not to deviate in the personal too much, but you guys know, like Jose and I were talking about this, how the sector is important to each of us on a personal standpoint. Maybe you have family or friends who are affected by some condition. And the last 5 months, I was in Peru before, and then I came home early to help take care of my parents, one with a heart operation and one with my mother with her Parkinson. And what's I don't want to say nice, but interesting is somebody is in the background there. Sorry about that. I don't know who that is. Let me see if I can get that. There we go. But the interesting thing when you know you have the right strategy for you, like for me, it's all about sleeping well at night, base hits over home run situations where it's heads win big. Hopefully the tails, the downsize is limited. And then we'll occasionally have the home runs like we did with APLS where we woke up to a buyout. But it's that nice that if you're going through I don't want to say like a rough patch, but something where maybe real life is taken away from your time on screens, it's nice that you have a strategy that can, whether you mean run itself or where it's not adding to the stress because you really found what's working for you. And maybe that resonates with some of you guys here with what you're doing. And Wassim, you as a father, for example, you definitely are, as you told us, in that stressful period of managing work, managing all the videos you're doing on biotech TV. And now you're down to just 5 names, right? And so it's nice when you're able to focus on what's working for you and kind of be dialed in regardless of what's going on away from screens too. So that was definitely a light bulb moment for me recently. Like you're seeing performance do well, but it's just really the system running itself, the same selection criteria. You guys saw my playbook post I published, was it yesterday or the day before, the setups I have on radar for April. On my phone to try to eliminate emotion. I have all the playbook setups. That started as just something on my phone. And then 2 years ago or something, you guys asked me to turn it into a series of posts. But the idea is I continually organize those setups, much like chess. You plan your next moves ahead of time. It helps eliminate the emotion. Prioritize them based on actionability, which ones have the highest upside. But maybe you have 2 ideas, portfolio cage match, pitting them against each other because they have similar downside cushion, but maybe one has much higher upside. Strategic value to acquire. Apellis, for example, I think we have quite a few buyout potential names in the portfolio, and I have no crystal ball winner if those will get bought out. You know, we've been frustrated with Syndax recently, but it is nice that that's part of the criteria there. So like Tom said, hopefully a few less squirrels, but just dialing in on what works for me, and we'll see what happens. So
Yep.
anyway, that's my little rambling to start coffee.
Yep. I would like to add to that something I've learned recently was that it's almost impossible to, as a person, to follow 20 tickers, for example. It's
Yes.
impossible to know everything. It's impossible to know the companies deeply, listen to all the earnings call, follow everything that's happening around the company. Because if you own a company, it's not only the asset. You need to understand who's competing with it. You need to see what other clinical trials are happening that may change how your company is going to perform. So, like sell side analysts, they are given maybe 10 names that they have to follow. Even biotech funds sometimes follow 5 to 10 names. So in this case, it's not diversification is not good. It's diversification, as Stan Druckenmiller says. So really knowing your tickers, knowing the company inside and out is critical. Also, I've been asked recently by someone because going back to LinkedIn, it gives a lot of networking opportunities. So I was asked if I reach out to IR departments and management, which I never did, and I was asked why, which was a great question and makes me think, why not? Why never reach out? I think that most retail never reach out to either management or IR, and I try to take a look and be the face of retail in biotech. And if that's the information I have about a company, that's probably everything that retail has. But maybe I should change my strategy. Maybe it's a good idea to reach out to management.
It's always funny about reaching out to management because at least for me, I used to do more of those, use ROTY, get foot in the door, get those CEO interviews. And the problem is if you have cheerleading management team, at least for me, I can get carried away with them. They're explaining how great the story is, or you see a few patient case studies where, tumors regressed or whatever, whatnot. Somebody's having a great experience and it can just take you away. And the other thing that it can get you carried away with the patient experience, but forget about it from an investment standpoint. And the other thing that you said really resonated with me, Wassim, is I found my sweet spot also is 10 to 15 names max to follow. And if I try to do more than that, or if I try to run, and I've tried it several times, you would think I'd get the message by now. If I try to run multiple strategies at the same time, it just is a recipe for mediocre results or lots of mistakes. Even following 10 companies and doing it well, you have to follow the investment landscape, the competitive landscape. It's easier with something maybe like Rocket Pharmaceuticals and Danon because there's only one Danon program in the clinic maybe right now. But with the crass landscape and cancer and pancreatic, one mistake many investors make is they'll compare the drug candidates only to the drugs in other publicly traded companies, but you also have to look at the private ones too. Go through the clinicaltrials.gov search engine and see everything that's in, late stage or mid to early stage. And if you do it right, there's so much to do. Or it reminds you to focus only on areas where there's only a few competitors. It's a lot easier to compare them versus ones where you're looking at 20 companies going after the same indication or something. So that definitely resonates with me, what you're saying. Jack's nodding his head.
Yeah, well, that's probably one of the reasons why I could become invested in transmedics. There was no competition. There was no market segment. There was nothing. I didn't have to follow, 10 names. I wouldn't be able to do, like, one of the questions that occurs to me, like, if you look at the analysis that Tom does, it's very granular. And that's a lot of work to gather all that information and organize it and have it analyzed. And I don't know how you can do 20 names. It's a full-time job, it really is a lot of work.
Well, I think that's also one way, we talk about trade to live versus live to trade. Like that's how I try to design the service. Like if I'm a person who has a full-time job and maybe you're checking on these companies, their quarterly reports and trying to be as low maintenance as possible. So you're looking at, each quarterly report, the burden of proof is to show whether the thesis is on track or strengthening. You keep holding patiently, or it shows that maybe, management commentary shows less confidence or something that you don't like and you sell. And the same goes for, clinical data or regulatory catalysts. They're all an opportunity to see if something's going the right direction or if we should, sell and move on. And so each week, some weeks it's just the weekly recap. Some weeks it's the trades, or this week it was the April's playbook, potential setups on radar. But I'm not a big fan of fluff because we're just wasting each other's time. It's better to have whether it's just one quality setup out there or a trade post. And otherwise, a few weeks where most of it is just the recap and what we're sharing in chat. Let's not spin our wheels and waste time on things that people don't have time for. Jose, I think I saw you posted in chat right before the close that you were finally putting some money to work because the last few months you were saying it was mainly cash, right?
Yes, and I still stay in quite a bit of cash and also in names, in Swiss names such as Swisscom, Nestle, etc., which are not necessarily names that people would be interested or care to hear about. But those are names that are quite defensive and have and I have been bearish for maybe a few months. So, however, I don't trust myself being fully into a bearish mode and put my money that way. So I just put that money out and be more cautious, which is my approach. So keeping what I wanted to keep and going that way and waiting for opportunities. That's what I was basically doing. And this week I have been quite curious about the weakness in biotech. I don't know if it's rotation, I don't know if it's something else, but it's been weak. And it's pretty much across the board, most names. And in general, when I see some names that I tend that I have or I own, and the ones that I like the most, right? And I see valuations still attractive to me, right? Because if I own them, it's because I expect them to go up significantly higher, right? So I found an opportunity, and that's what I did today. I also added a couple of extra things. I added, in addition to the ones that I posted, I added to New Amsterdam, and I added a few additional calls to AbCellera. So I did that, and I might be doing it again if I continue to see weakness. As long as my hypothesis stays in any of the names that I'm in, even if it's a trade, I will stay. So, in or add. So that's
Did I hear correctly? It was AbCellera,
that
ABCL,
is
because
correct. And you know that what I think about the company. I still believe that, but there is one particular asset which has a personal component for me and for people that I know, and that is ABCL 635, because that is hot flashes for women. And that one has a particular interest of mine. Everything else, to be honest, no, I am not bullish at all.
that's why I was asking, because I remember before you had some pretty negative remarks on X about it.
Correct. That stays. I don't believe in that AI thing. I don't believe that the partnerships can be monetized that way. Otherwise, they wouldn't have changed strategy. The 575 asset is basically a zero. So the only one that could have a potential, that's 635, and that's a biologic that if big if they have some better safety profile than Viosa, that is an oral, and I can say this because I've seen it. It has quite negative toxicity. Someone took it once and couldn't take it more than 1 day. So in Liquid, it's in the market, but it also has some things. So there's a potential there. So I want to see. That's why I'm using call options. If there's nothing there, fine. Just lose the money and move on. But this is not the company; it's just the assets.
Call options on that asset. Do you know when the readout is coming up, or how did you position for that?
Okay. Why is that? And that's the other thing, right? These pre-announcements, and I happened to see that they were pre-announcing that on May 11th they were going to release data on this phase one assets, which was supposed to take place in the second half. So pre-announcement plus um, um, moving an asset that was supposed to be read later, sooner. Those are things that I tend to favor. So that's what I'm doing. It's just call options for that particular readout. Yes, no, that's it.
Okay. No, thanks for that one. That's a new one that we haven't discussed. I saw
Yeah.
Mike from NZ is here, and before I ask him what's up, one in the recent, I redid the introduction video to ROTY for new people just because it's changed over time. And one thing I remember to say that came to mind is my personal strategy has only come together because of the people in chat. Like I learned things from, and maybe it's same for you guys, from people smarter than me. So like from Jack about regulatory clarity and how much he doesn't like the FDA makes me steer clear of situations where it's very high on regulatory uncertainty. From Tom, he's always getting on my back about more sheep and less squirrels. Jose helps me with not getting shaken out of my positions, like holding things more patiently as long as it's going in the right direction. And Mike, you can correct me, he was either managing a hedge fund or traded for a hedge fund, and he was telling me about his tier system for position sizing, and I've pretty much borrowed it for myself. Like you guys know, 10% portfolio weighting is the maximum I'm allowed to buy on my own for commercial stage. From there, it can grow on its own organically. I've had some positions like Nuvation before we sold it in the nines that were closer to 20% of the portfolio, but the max I can accumulate is 10% for commercial and 5% for a clinical position. But I think of those in my head. This is just mentally, it's not something I write out, but tier one for me is 10% of the portfolio. Tier two is 7.5%. Tier three is 5%, and tier four is 2.5%. And like Mike said, stocks move up and down those tiers based on price action, based on news flow. Maybe you take more partial profits when the valuation doesn't make sense, or vice versa. And so it's nice, just another way to sleep better at night. But anyway, Mike, what's new? What's the newest from you? If you hear me.
I know, yeah, sure. No, I hear you. Actually, it was funny. I recall actually recently someone in chat was like, people were talking about first quarter, and I have absolutely no idea who it was, but I remember someone in chat saying that it wasn't that hard. It wasn't that hard to have a really good first quarter. And so I was kind of chuckling when I saw that, because I frankly had a not good first quarter, and also year to date I'm just really not doing all that good either. So I've missed every buyout, including APLS. I never actually really liked the APLS story from just from a professional investor sort of perspective. And the thing I didn't like is I, the stories where like you have one primary drug that's not doing that well, but then you have like a smaller drug that is doing good. Like, it can take those stories a really long time to work. It can take a really long time for investors to start paying attention to the smaller drug. But kudos to you, Jonathan. It was a terrible idea until it wasn't. And so I completely, on the one hand, I never had the like sort of daily pain of the Palace drawdown, but at the same time, I likewise completely missed the like 10% position going up 137% in a single day. And I likewise, I've missed every other. I haven't scored a single buyout this year, and then coming into the year, I sort of had two like really large positions, one non-biotech, one healthcare but non-biotech. So I had a large tech position that had gone up several 100% last year, and I held it in my taxable account. And I really didn't want to sell it because I didn't want to realize the taxes. And that stock turned out to be literally the absolute worst performing stock in the S&P 500 in the first quarter. So that stock was down 25-30% in the March quarter. And then my largest healthcare stock was, as some of you may know, was ADMA Biologics. And so that was the stock I owned because there was no clinical risk. And they generate, or at least will start to generate, humongous free cash flow. So it just seemed like it seemed like a relatively low risk and potentially attractive buyout candidate as well. Remembering that Brookfield actually tried to buy one of their competitors, and then there was a short attack. So the stock did not perform well in the first quarter, and then on top of that, there was a short attack a few weeks ago. So my largest stock is down like 25-30% this year. And then ADMA, which is sort of my equally largest position, is down like 40% year to date. So yeah, so and those two positions were materially larger than anything else. So yeah, it just has not been a great year so far. I mean, not just like, I've had some wins, of course, along the way, but it really hasn't been a great year to date.
For what it's worth. Oh, go
sorry,
ahead.
John, can I say something here?
Sure.
Yeah. Hey, Mike, this is Wilson here. So APLS is a name I know very well. And I understood, like, it's basically a value name. You talk about geographic atrophy and how do you really kind of grow this business, right? And then you talk about the kidney side of things, which is a whole other mess. And no, I was actually in the same boat as you. Like earlier last year, I was I had a position in APLS, and I was like, well, like, I understand what the thesis is here, but like, there's definitely value here. There's no doubt about it. But can you, is there a better opportunity? And like, I was just looking at things that are coming along, and and just based on like the news flow and whatnot, I came on Imix Pharma, which is the BCMA for AL amyloidosis. And I don't normally do companies that small, but I was like, yeah, this kind of fits what I'm looking for. So I sold my APLS shares at like 23 or 24, whatever it was, and bought Imix. And the funny thing is, like, Imix is 150%. If they held it to APLS or whatever, it's like it'd be roughly the same, right? So like what I'm trying to get is that, like, there's like 1,000 ways to skin a cat.
No,
like,
absolutely, yeah. Absolutely.
I could have stayed in APLS. I would be fine. I could have do what I did, would have been fine.
Oh, thanks for that. I want to echo what Wilson was saying, just that I had a couple people message me and they were like, man, I bought all of your stocks that you own except for APLS, and they're being hard on themselves. But you have to keep in mind, even last year when Jose had 5-6 buyouts, I had 0, or I had just SpringWorks, which was like a 10% premium or something terrible. And you have to always ask yourself what the other scenario would have been for the company that did work out. So for APLS, sure, it was nice to have 10% portfolio weighting, buying it at lows and wake up to the win. But what's the converse side? It could have easily been a really stagnant stock pick that stayed where it was or traded lower for another year or two until Syfovre sales rebound, if they did with the prefilled syringe, if they made more progress with expansion indications for Empaveli. And in the meantime, if none of that happened and it was just a year or two of just execution, maybe the stock would have stayed there in the teens and done nothing. And the whole time I would have been worried about opportunity costs. Like Wilson said, do I have a better place to invest these dollars? So it's really easy after, as we call it in chat, hindsight capital, to get really on our own cases and be like, man, I should have bought that. But everything's clear looking back on it, right, Mike?
No, totally. And actually, MX I do own, so that definitely has been a nice performer. Yeah, so it's not like nothing is working, but it's hard to have a really good year when you miss or at least year to date, when you've missed all the buyouts and by far your 2 largest positions are down materially. But I'm optimistic. I've had some good wins this week, but we'll just see how the rest of the year goes, right?
No, definitely the year is early. I always feel like if you're having a good patch, a little bit of a hot streak, things are going well, it can always reverse on us just as fast. And I've had some years where I start out pretty terrible or non-plus, or you give back some gains, and then you finish the second half very strong. So you kind of just focus on the controllables, and you never know how nicely. Unstupid decisions, non-idiotic decisions. Like for me, the number one thing is just not shooting myself in the foot. And if I do that, then hopefully some decent setups, a few base hits will make our year.
Yeah, I kind of feel with biotech too that it's almost a case of like not losing too much money from January through September, which tends to be the toughest period for biotech, and then basically you make all your money. So October, November, December. So sort of.
That's funny. I never had thought of that. That's funny.
Yeah. So sort of.
Well, no, that's more on the institutional side. If you're working a job, for sure. Yeah, for sure. Yeah.
I guess since we're around 440 or so, we go through the ideas. If anybody has a top holding or something you wanted to discuss with the group. Normally I come with like a set list, but I already mentioned that. The only other thing I'll say that's nice about biotech doing well is you guys know we have the partnership for 8+ years, ROTY, with Mama Lis Foundation in Venezuela, which is kids with cancer down there. The way I describe it with their healthcare system broken down is that, retinoblastoma is an eye cancer that in the States is 90% curable. 90% of the time you can cure it. And down there, it's less than 50% due to not having access to chemo, not having access to scans. Stat News did a really interesting piece somewhat recently about the chemo coming from India, a lot of it being low quality, and that they were having more patients relapse on it. And what's interesting is Liz sounded the alarm on that earlier than the stat article because they were seeing that firsthand with the kids in Venezuela. So that's just a thanks to everybody that, it's fun when a biotech bull market's going on, or at least a rebound. We've been able to knock out a lot more of those cases, and that's also with the membership dues. So cheers to everybody on that. Thanks. And with that, open floor, any ideas you want to share, setups, top holdings, you name it. Floor is open.
Yeah, John, can I say something there?
Sure, go for it.
Yeah, just going back to I think it was Tom's comment. A while back about how you can cover so many names. I guess the reality of the space is over the time I don't know, you almost build like a portfolio or a repertoire of indications that you understand, right? And whether you go along them at the time. Can you hear me, by the way? Okay, just make sure. Whether you revisit them down the line, or whether you go along or you just put it to the side, you kind of remember these things. And over the I've been doing this for 14 years. Over the time, you don't necessarily forget these things. So that's realistically how some of these traders and analyst investors, they keep track of 30 names, 50 names, 40 names, whatever. They've just been doing it so long that even if they're not up to date, they can just go back to it, check the notes, and they'll be good within an hour.
Okay, no, that makes a lot of sense. Thank you. That also kind of echoes. I haven't been doing like that long, but one thing that's been nice in the past, I used to always kind of put my research in the trash on a name if it didn't work out. If I didn't end up choosing it. And maybe 5 years ago, I started organizing my Google Docs by month. And anytime I'm doing research on a name like Rocket Pharmaceuticals or whatever, and then I don't end up choosing it, I still keep all my notes under, April 2025 or whenever I did it. And so it's nice that when you do revisit names and maybe they do meet your selection criteria later on, you have all these notes from prior calls and prior quarterly reports that you read or listened to, notes from the filings, annual report, et cetera, KOL calls. So it's nice that when you do revisit these names, you're not starting from square one again. You're starting from a base of knowledge that you've already created. So it's nice for me to kind of see that playing out too.
Can I maybe ask something related to that? It's a relatively broad question, but
Go for it.
For me, there is one thing following, let's say, the 15, 20, 30 companies you have in the portfolio, but then much bigger beast is actually analyzing all the new ideas and shortlisting the ideas and prioritizing the ideas. So do you guys have any strategy for that? The idea generation and just not getting lost in the sheer volume of companies you are looking at?
One thing, I don't know if this is helpful at all or not, it kind of makes a mess of your account. I've been talking about it before. I used to keep a separate account where anything that caught my attention, for whatever reason, I would just buy one share and put it in the separate account. And or you can, obviously if you organize your account by dollar value, usually the one share ones all end up accumulating at the bottom, unless there's some of the black sheep that I buy, in which case 100 shares are sometimes worth less than one. But but I find that it keeps them in front of you, and you can just, a lot of the time what I'll do is when the market opens in the morning, I will just scroll through the whole account very quickly. And of course, one of the columns is always, there's the dollar value, but there's always the percent change, and you very quickly get a read on if anything's moving up or down. And I'm if I've got one share of it, hopefully only one share, I'm often more excited to find one that went down 30 or 40% than I am to find one that's moving up, because the ones that are going down 30 or 40% tells me something has happened. And you quickly can flip open and find out, maybe you go to StockTwits or you go to the website and you find out what blew up. and I think it's a great way to fairly quickly identify things that are daily or quick movements, and they in general it just kind of keeps everything in front of you. Then what I'll do if any one thing gets interesting to me, I'll begin accumulating shares, but maybe I'll buy 10 or 20 shares, and it has the effect of moving it up the account list. But I mean, my one big account's probably got 200 names in it, and but a huge number of those are dollars and pennies. And but if I find something I like and I buy 10 shares, then it'll maybe have $200 worth of it, and it'll move up to position number 25. And so it's just kind of a easy way to keep track of stuff. What's kind of ironic, though, is sometimes when you scroll through it and you look at all the ones that you put all the time and energy into, and you find out that the ones that you have one share of are outdoing all of the ones that you thought you were being really smart about, and then it's kind of like, maybe I shouldn't analyze and I should just keep throwing darts. But it's also an interesting way too. You get a beat on the market if you're only holding 10 positions and you happen to have 5 of them that are having a bad hair day, you start to think that the whole market is down. But if you've got 100 of them or 200 of them in your account and you scroll through it very quickly, just rolling your mouse ball, and you see that it's 80% red, it immediately tells you that your 5 are having a bad hair day, but it's not the market. So there's some interesting things that you can get out of doing it. You just have to manage the clutter.
Actually, Tom, it's funny. I do exactly the same thing. And one other way I use that is, say, with a biotech company, if I have a biotech company in a particular space that I like and I own the stock, then I'll also buy like one share of their major competitors. And then sometimes that might be 2 or 3 other companies. Then I'll just add that one share to my stock holdings. And then if there's news on those companies, they'll see, oh, this stock is up or this stock is down. And it'll remind me, oh, that's right. Like these guys have a drug that's competitive with this other company that I own. And that'll help me stay on top of like what's going on and what's affecting the companies that I do own.
Interesting thought.
But it's funny what you say, because I've actually had the same experience. It's like I'll go back to a company where I have like one share like tracker position, and I'll think, oh, okay, like I think actually I really want to own this company now. Like I want to buy some shares, and then I'll be like, oh, the one share I bought is up 66%, since I bought that one share.
Yeah, but by the same token, I think equally often you'll find one that maybe gets your attention that's interesting, and you'll buy that one share, and all of a sudden at some point in time you'll go back to it and it'll be down 66%. And to me that's a big flag that says if I liked it then and it's now 66% cheaper, did it implode or did the market just drive it down, and it's something that I should really be looking at seriously. And I find that to be pretty helpful. It can cut both ways. Yeah, you can kind of feel like you missed the train, but at the same time it can also highlight things that are suddenly turning into opportunity land.
Yeah, and that's very interesting because I just watched recently a biotech TV interview with Joseph Edelman from Perceptive Advisors, and he mentioned that they had a very long tail, and they just went to look at their holdings, and they have more than 120 holdings in biotech only, and most of them are like $10,000, $3,000, maybe $100,000, and they're very focused on like a few. Most of their money is focused on like 5, 6 names. And then they have this long tail, which I'm assuming now that they're doing what you guys are saying. They're tracking names that way.
Yeah, well, same. I was just saying there, like, I can't remember if it was Perceptive. There's another, maybe it was Jack or something, but they had a really good point where it's, I'm actually pretty sure it's Perceptive, where they were like, like we talk about position size and stuff, right? And they were like, we size anywhere from like 0.5 to, let's say, like 6% on a new position. And that's kind of where I am. Man. Like, I can't speak for anyone else here, but like for me personally, if I'm doing a pure equity position, right, no derivatives or anything, maybe it's just a cash, whatever, right? If I can't justify at least 0.5% of my equity portfolio, not worth it, right? I'm not gonna deal with that shit. And 0.5, like people say like that's nothing, but like it's not nothing. And like that stuff adds up, and like the more important part is like it takes like brain power that you can spend on more useful activities, to be quite blunt. So like I stay with that. Like that's what's worked for me. Like if I can't just fight at least 0.5% on a equity position, I'm not doing it.
I have to interject in what he said there. It resonates so much. I don't have enough.
Yeah.
Personally, I have a very limited supply of brain power. So I have to have that spin on companies, on names that I'm going to want to accumulate a decent portion of. Otherwise, why do it?
Yeah.
Well, see, for me, in the model, the picture I'm painting, there are at least three, if not four, tiers of of holdings. The one share is simply a tracking share that isn't there to occupy any of the limited amount of RAM that I have between my ears. It's there to actually help the RAM because when I forget about stuff, there's nothing worse than having something come across your plate and it's interesting and it catches your attention and you set it aside and then 6 months later it's up 1,000% and you're going, gee, I remember that, but I didn't do anything. And so the one share is in there just to keep you from forgetting stuff. It's not there to occupy brain width. I totally agree. If I'm committed to anything, you've got to have at least 3, 4, 5% to have it make sense to be really committed to it. By the same token, though, if you're in things I think that are highly volatile that could move, 100% or 50% on any given event. Grace is a good example. I mean, I had 7% of Grace, and it was going up to a PDUFA, and I knew the date, and I got, maybe 20% out of it on the run-up, and then, I don't, despite all of the encouraging news that Jack has put forward and the reasons why we should trust the FDA, I'm still a little bit apprehensive about them. And so I cut Grace back to, actually a little under 2%. And of course it blew up and it's down 50%. And on that 2%, I lost 50%, but on the 7%, I made about 20%. Overall, I'm probably a little bit ahead. But I think you can be in the game on a small position if it's highly volatile. But if you're looking for something over time, I totally agree. There's got to be 5%. And then at the top of the pile, there's the stuff that I'm all in on. And, I'm sitting there with, 30% in FBio and another 7% in FBioP and another 5% in Derm. So, I mean, in FBio collectively, FBio or FBio companies or widgets, I'm probably like 45% into FBio. So, that's when I kind of want to pay attention to.
Sure.
Just a quick chime in here. It's good morning, Vietnam here. I'm in Saigon right now, 4 o'clock in the morning.
Whoa.
Listening to
Wow.
JF.
Hey, good to hear from you, Ray Rosen. Cool.
Yeah. On the strategies of following stocks you like, I really find useful setting up alerts and watch lists, and every morning I'm getting news on the stock I like. So I never buy like small position just because I don't want to see it go up 150% in one day. And if I like something, I just buy it. I make it 2% of a portfolio and buy it. And this strategy is well described by my guru, Stanley Druckenmiller, who said, if you like something, buy it and then figure out what is the next. So this is my 2 cents here.
That's more than 2 cents. Thank you. Times, but probably not frequently enough that I set a lot of alerts, price alerts, for companies I like, but they're too expensive. Even Tarsus came to mind where, it ran back up to 74 or something. So I set alerts at 60 that recently went off and got me to revisit it. So I do that with a lot of companies, and maybe only a very small percent of those alerts go off. But you never know, like it'll be like the names that you like the most that ran without you will be the ones that most surprise you by, at least for me, by giving me a second opportunity to enter or re-enter. So I'd say price alerts are very, very important. And going back to the other question too, like sometimes hearing you guys mention your approaches, mine feels much more simple, like just a simpler guy, I guess. But like on Playbook, remember before I did those series of posts, it's just on my phone. You probably can't see it, but literally maybe once a week, I'll go through the list of names, like Xeris, my most recent entry, XERS, Xeris. And these names, I will once a week reprioritize them, move some up the list, move some down the list based on the price action, based on news flow. And so it's really funny, names at the bottom of the list will sometimes move to the top, and I enter them like Iovance in the low 2s. I never expected to enter that one again, but it was a confluence of things, listening to a KOL call on Slingshot Insights, a recent webcast, etc., where you could tell that the momentum was improving, the bottlenecks better taken care of. Even recently, Rare, Ultragenics, re-entering that on the dips 19. I didn't expect to be able to get that at that level, and that happens. And so it's interesting. The takeaway maybe is having a short list of names you're interested in, and those kind of move up and down based on which are the most actionable. OMER is one that Tom talked about for his sheet portfolio, and that fell to the 10s where it moved up on my list, and I entered too based on I think it was their formulary numbers, initial gaining acceptance on the marketplace were significantly higher than I expected them to be, and so that's why I raised that one up on my list. Also, after the APLS buyout, it seemed like there was more demand in the kidney disease space, so the MASP2 pathway might have some strategic value to acquire 3. So it's cool for me, at least, keeping that list and seeing how names move up and down based on price action, based on news flow, based on valuations, etc. So that's my, as A. Rosen said, my 2 cents too.
So where does the initial list come from? So you have the list, you are moving the priority up and down, but how do you come up with the list in the first place?
Great question. Those are just names that I'm researching over time. New ones get added, like Tarsus, TARS. Now that it's fallen to 60, I just finished revisiting it, and if it stays at 60, it'll probably end up on the May's Playbook. And then other names get removed, like I think we had Corcept on at court for a while, and when they had the news of the liver toxicity that caused some problems, I felt like I no longer had an edge in that one, so I removed it. So a lot of names on the list get removed because the news flow gives me something I don't like. It could be because they run off without me. So it's just trying to find those companies that have all those criteria I'm looking for, strategic value to acquire. Hopefully there's a situation where it's heads win big, entails the loss is limited. There's a management team that's not cheerleaders. They actually say what they're going to do. There's an accelerating clinical and commercial momentum. Like I'm looking at these companies where they're going to go 2026, 27, 28. With Syndax, for example, we're seeing sales accelerate in the relapse refractory AML setting for Revuforj. This year, they have the maintenance patients coming on post-transplant. They have the NPM1 launch. They'll have more Veneza frontline data. They have the IPF readout for Niktimvo later this year. And then after that, they'll have the first line readouts for AML. So I need a steady stream of catalyst to keep me, interested. Otherwise, it's like watching paint dry on a wall, and I'll get bored and most likely end up selling, and then the stock runs without me. So it's definitely more, it's equal parts art and science, and I'm still working on it. I don't claim to have it figured out for sure.
Yeah. Sorry, Eliska, can I ask like how long you've been doing this for? Like biotech investing?
Yeah,
Good
so
question.
I
Go
come
ahead.
from academic environment originally, so I have a PhD in genetics, and
Okay.
then I got a job in hedge fund specializing on biotech. Like the hedge fund is actually not specialized in life sciences, but we have a biotech portfolio.
Sure. Yeah.
And I started in the very end of 2023, December 23. So
Okay.
yeah, it's
So
been
you've been
2.5 years.
Yeah. How there's lots that's happened in the last 2.5 years. Like how are you feeling like in terms of your own confidence? Like
it's been a roller coaster. I have to say, like starting in the end of 2023, I felt like biotech stocks just never go up and it's impossible to ever make money. Then suddenly when I felt, I think like April last year, I was almost like myself starting to believe again, because I was like, either this goes up or healthcare is gonna end.
We're
and
not
at
gonna
that point
die,
I was like, I was investing almost out of anger. That was the time when I was like, fuck that, my personal money goes in as well, because this just has to stop somewhere, right?
Your PA, yeah, exactly.
And then suddenly, like, the world has changed in biotech, and it went up almost like way more than I expected sometimes. So I feel like it's been a short time, but a lot happened.
Yeah. So like, are you still working at at a hedge fund, or like what's your deal?
Yes, yeah.
Okay, is your fund like kind of like I don't know, because every fund has like their kind of they have their strategies, right? They have like the kind of like mandates and stuff. Like is like how they think about things kind of aligned with how you think about things, or is there deviance there, or how does that look? Do you know what I'm saying?
So as I said before, biotech is a small part of what we do.
Sure.
So the strategy for the biotech portfolio per se, it's actually quite high risk, high upside. So I think to some extent, this maybe is sometimes different to what my personal investing would maybe look like. So for instance, like APLS would be an example which I have pitched it for the fund. The feedback was, it's like not juicy enough for what we wanted to do, which is kind of funny, because then I bought it for myself because the fund didn't want it, and I ended up like being over 100% up on it, which I did not even expect. So it's definitely like higher upside plays.
Yeah. I guess like, I don't know, like that's really cool. I guess like why or do you want to kind of like, I don't know, like what I would say to you is like, like in biotech, I've been doing this for like 15 or 16 years, and I don't know, there's like literally a million ways like you could skin a cat on the long side, on the short side, and like there's so many things you can do, right? And like maybe that's aligned with like what you're doing in your job, because like I understand like a hedge fund, like they typically have a kind of mandate or something that they really try to go with, right? And if you're not aligned with that, like it's it's hard to pitch to your portfolio manager, right? I don't know, like it's really I know like this sounds like a cheap comment, but like the vast majority, the reality of this whole mess is like it's really one of these spaces where like like after a few years, you kind of have a sense really of like where you have an edge, or like what your element is, right? And like and maybe that's aligned with what you're doing, maybe that's not, and if that's not, well, maybe hopefully you can trade your portfolio or your personal portfolio, or but I don't know, it's a big shitstorm. I don't know how else to say it. And, I guess that's why we're all here. It's You know, it's such a fucking joke, to be completely honest. But like,
Yeah, it's not boring.
it draws us all in, and like we're all making, you know, a living off this for God knows how. But like, you know, it's a fun time. I guess I don't know.
Maybe it's definitely not boring. It's very fun. Like one thing that I would say, like looking at the 2.5 years I was in biotech investing, what I find really hard is sort of how much the biotech is like obviously affected by the macroeconomic situation and how much of it is momentum.
For sure.
Because like there's one thing is you like the company, you like a drug, but you kind of know that it would have like the exact same situation would perform very differently in 2024 and now. It's like the environment is so different.
Yeah, that's a good point though, right? Like it's like yeah, like I completely agree. Like, you know, you have all these things like, you know, what if, you know, like Trump or like Biden or I don't know, like the whole thing's like this, right? But like that, you know, believe me, I understand where you're coming from. Like it's super frustrating, but like, does it matter in the grand scheme of things? Like, I don't know, like, no, actually it does. Like, let's not compare ourselves, but like, and like, you know, you have to make money, right? So how does that affect your investments? And you just go from there.
I guess.
Yeah.
Go ahead.
Like, how much brain damage are you gonna take? Right? Like, so like me, like, you know, I used to do a lot of PDUFAs, and like, you know, I was pretty good at them, and now like, well, I was getting like, you know, I was getting killed on a lot of them, like, you know, the last 2 years. I was like, you know what, like, I kind of come to the realization that like, you know, the FDA that I, you know, was friends with, I know these people personally. It's not people I know now, and you know, and these people don't answer my phone calls and shit. So yeah, maybe I should adapt different strategies and like spare myself the brain damage, right? Like really, that's what it is. Like it's like you know, there's always factors you can change about it. It's like it's weird. Like there's so many names, but there's so much shit going on. To be quite blunt, that like I don't know. You just like you know, you just I don't know how to say it. You just manipulate shit until you get something that you want, right? I know it sounds really cheap. But like that's really how I think about it. It's like well, like you know, like I can manipulate 1,000 things, like 1,000 variables. Now, yeah, that looks fine. I'm good with it. I'm fucking lazy. So.
I like what you said that as far as headspace too. Like it's all about is it worth how all these things flying at you are affecting your headspace. Like I used to do a lot of swing and catalyst trading, especially in my 20s. Had a few lucky wins and things that, you know, back when I lived in Peru that paid for the condo or the businesses, whatever. But then this was before your time in ROTY, but my clinical pure, the swing trading portfolio completely round tripped before it was up, you know, 400%, and then it round tripped to zero. And the light bulb moment was, hey, I no longer have an edge in doing what I did before. The service either shuts down because I'm not adding value, or, you know, because if you're just a guy who's writing articles but not making money, what's the point of this? And then I pivoted to more commercial and late stage, and I learned, okay, this early stage stuff I have to steer clear of because my track record's too poor to justify it. So you have to know what playground, what sandbox you can play in.
Yeah, for sure. Like you know, I'm not gonna cut it. Like, you know, like the weird thing about biotech is like there's so many fucking egos here, and like you know, the funny thing is like, you know, if you go on Twitter, all the institutional people, they're gone. Right. So all the like let me make this perfectly clear. All the really good people on Twitter are gone because most of them are at hedge funds, and compliance has cracked down, so they can't actually say what they think they actually say. So they're just watching all of us tweeting our stupid stuff, right? No, I'm actually being completely serious, right? I'm actually being completely serious. That's where we're at right now, right?
Yeah.
No, 100%. In chat, we've seen that too. There were a lot of guys who were active before, and whether they're now like heads of companies or they're at funds, they message privately, but they don't do publicly. There was a guy who was
like, it's a huge thing. Like people don't understand. It's like, you know, like I don't know how to say this. Like, to be quite blunt, the feedback you get on something like Twitter, which I think most of us are, that's not fed through compliance. And whether that's a good thing or not, That's up for debate, but I'm telling you, because I know these guys in person, I would say at least 95% of the time, these guys are in the right. So make of that what you will.
95% of the time, these guys aren't what?
At least.
They are in terms
they are the right. They know what they're talking about, right?
Mm-hmm.
But they can't say this stuff on fucking Twitter or social media, right?
I might be headed back to Medellin in the future. And last time I was there, I met a guy who was he researched for he called it a small fund, and it ended up being like 300 or 400 million. So I guess that is small compared to some.
That's not small. But like, okay.
Yeah. But he was he knew all the guys behind all those usernames you were saying, and so it was funny when he was telling me all these things like Bakery Brothers or whoever, and he's like, "No, this is who that guy is." Oh,
yeah,
that makes sense. Well, I guess we're running toward the end of it. Anybody last thoughts? Any other names you want to highlight, mention before we wind it down? Any other setups? Go for it.
Yeah, just to follow up on what Eliska was mentioning. I went into this rabbit hole of watching Joe Edelman's interviews and reading his articles and interviews. And he mentions that biotech is driven by sentiment and perception. So all of clinical is perception, what people perceive the drug to do and the asset, and how it's going to be marketed. And another thing is reality. And there's sometimes a big gap between reality and perception, or sentiment or speculation. And so that's where they play between, reality and perception. And that's why they call it Perceptive Advisors. I think that's a very cool way to look at it. Now, John, you don't focus on perception, you're looking at numbers, and that's a different way to invest. And that's very cool. I think it's safer. But most of it is driven by sentiment and perception.
Sorry.
Go ahead.
Sorry, I'm so sorry. So Wassim, like I love that point, and like so this is the easiest example I can bring down, right? So like if you look at the screeners for this year, right? Like what are the top names? It's like APL, we always make a joke of it. Eliska, right? Like the one founded by Jonathan Blim. Who is like the next RevMed advisor. So like what's you think so like what's coming out of this, right? And the whole story is last year RevMed was at $7 billion valuation. They're pushing their anti-RAS in pancreatic cancer, right? And now we find out this works, and now this company is trading at $30 billion. And to be fair, like biotech has gone up from expect from 65 to 130, whatever the fuck it is. And now, I think it's actually phenomenal, and I've done this so long that I see how these people think, and now they're if RevMed is trading at $30 billion now, why don't I buy Eliska for $7 billion? Well, Revolution Medicines was $7 billion last April or last June, right? And they had way more data, and I understand that Eliska preclinically has pretty compelling data. It looks good, right? But I always ask people, I'm not necessarily against Eliska, but try to put the financial incentive in. If you were at any period of time,
It gets muted.
I think he's muted. Yeah, you're muted.
Sorry. I was saying, can you hear me?
Yeah, you're
yes.
Yeah, so I was saying, Eliska now is $7 billion, right? Revolution Medicines was $7 billion in April last year, right? So, are you really going to bet $7 billion on this? No, don't run. It's a good mechanism, right? This should theoretically work. No, it doesn't. No, oncology moves fast, right? But if you weren't investing $7 billion into RevMed last Q2 or Q3, why are you investing $7 billion valuation now? Well, you had a whole fucking year, and I don't think Eliska is actually bad. Don't get me wrong. I don't think it's bad, but you have to realize at that point, well, I'm actually just trying to buy the hype because that's what RevMed is valued at. Doesn't matter that Eliska is 3 years behind, right? So like that, like I see this all the time, and like because I focus a lot in how the psychological part of things, and like this one's particularly egregious because like I can guarantee you, even like in like 2021 or late 2020s when like things were really bad, there was no oncology like Aliska trading at $7 billion. That's completely unheard of. And like again, like I think their approach is good, but it really kind of shows the kind of mismatch in like how people think about valuations, right? It gets to people's heads, right? Like that's really what happens. It gets to people's heads, and they stop thinking about the downside, think about what can go up and not down.
That also sounds like some FOMO, like somebody saying, I missed RevMed at 7 billion last year, so I'm going to go for a RAS now as a relative valuation play. The other thing that makes me think of is Tom always says, TDMInvest, what am I getting for what am I paying? And that really stuck with me. Like I'm usually looking at the current enterprise value. You were asking me how I find these names in Playbook. One of them is current EV versus peak sales, and I'm usually a lot more conservative on my peak sales estimates than the analyst reports you see, because I'm waiting for management commentary for launch metrics to prove it before I move my estimates up. But I found a sweet spot for the core biotech portfolio has been buying these companies when EV is less than 1 times peak sales, or maybe even less than 2 times peak sales. So again, these boring setups where hopefully it's heads win big and tails the loss is small because we have some type of downside cushion. So that does rule out for me some of these high flyers that could be really big winners, but they're just too rich for me to be able to play in that sandbox.
Well, I have a hard time with those kinds of values with stuff that is, substantially purely developmental. It's you don't know who is going to win. It only takes one bad trial. It takes one other guy having a better trial. There's so many things that can be relatively inconsequential that can take a $30 billion number and turn it into 5. And to me, being unstupid is, I don't buy $30 billion companies that don't sell anything. It just doesn't make sense to me. I mean, how can you sell something for $30 billion and not sell anything? I mean, it doesn't make sense. And, I would rather buy a 3-legged black sheep that's got, $10 million in sales that I can at least look at, and the company maybe is valued at $5 million, and you look at it and you go, how can you have $10 million of sales with 80% margin and only be worth $5 million? I mean, to me, that makes very little sense compared to even the 30 billion being 30 billion. I'd rather put my money into things that don't make sense in the other direction. And so it's a completely different way of looking at it. Wassim, you mentioned Joe Edelman. He's one of my heroes, actually, because he took like a $20 million position in, I can't remember the company, but it was like 4 or 5 years ago when I was trying to just figure out what this space is all about. And he proceeded over about a 4-month period to turn it into a $4 million position and sold it. And I thought, if Joe Edelman can turn 20 million into 4 million in 6 months, that's pretty darn cool. I mean, and because he's kind of considered a rock star. And when you can see that the very best can be have that bad of a failure, it helps you realize at least that not all of your failures are maybe as bad as you think they are. And there's so much volatility that if you get your crap together, you get it back on the next one. But, Perceptive didn't lose their cachet when he rode 20 million down to 4. I mean, for him it was a small position. But, I look at it and I go, that was still $16 million that vaporized, and that's a lot of money.
Well, that's one thing I like about community, I think, is whenever any of us has a hot streak, like last year it was Jose with like 6 buyouts or whatever, and then Tom will rack up a few black sheep that get bought out, or I have a decent patch or whatever. It's nice that when we intuitively we know when you're never as good as your hot streaks, and it's nice people pulling you down, back to earth. And then when you're going through a rough patch and you're like, maybe I can't do this, and people are like, it's just a rough patch, you're going to be okay. They give you some ideas what to do. It's nice that we can avoid both of those extremes.
Yeah.
And valuation wise, I completely agree with you too. Like when we bought Rare recently at 19, and I wasn't planning on buying it, that moved up to number one in my playbook. You were getting the or the approved drugs they already have, basically where the current valuation was based on their approved drugs, and you were getting the pipeline for free. And at the time, one of their gene therapy programs, which everybody doesn't like gene therapy right now, had just gotten it was either a submission or resubmission had gotten accepted by the FDA with a PDUFA date. And so you're thinking the priority review vouchers. And then you have a nice call option with the Angelman syndrome readout in early Q3, where they're the front runner there, I think, versus the others who are, nipping at their heels. But that's a very large indication. And so I'm not saying it's going to work out, but it is nice when you're buying a company based on their approved drugs and you're getting the pipeline essentially for free. That's the kind of setups I'm looking for, where a lot of things can go in our favor. And if I get it wrong, at least I think it was DSJ, who's still in our chat, but doesn't, maybe it's compliance too. He doesn't talk much, but one way he helped me, because I take my losers very personally. And even more so when you have 400 or whatever people who may have bought it because of you, because it's not just my loss, that's everybody who followed. And he kept telling me over and over until it got ingrained in my head. I'm a slow learner, but if you're going after these high probability setups, going after a high batting average, I'm trying to be right, let's say 70% of the time. That's my long-term goal. I have to be okay with the fact that 30% of the time, at least, I'm going to be wrong. And that's just part of the process. And that's just something you have to accept.
I just wanted to say something. I heard Tom saying about Revolution, and that was one of those names that I added today. And one of the reasons is because I believe that I can still extract a sizable higher valuation from where things are today. And I don't look at it only from the point of view of PDAC, but also from an from an NSCLC. So besides the personal aspect, right? But yeah, I don't get afraid of high valuation companies as long as where I'm buying can still get me significantly higher given the risk for me to exit. So yeah.
I think if you can answer, Jonathan, mentioned really one of my favorite questions to self is, what are you getting for what are you paying? And the difference between you and me on Revolution, other than like our strategy, is you know what you're talking about, and I don't have a clue. And so all I see is $30 billion for a company that doesn't sell anything. And as a business guy, that makes no sense. As a person who understands the excuse me, the potential of what they could be, because you know the science and you know the size of the indication, and you know that they've got widgets that actually could be truly revolutionary, and can be very, very big. For you, that makes sense. Now, the other stumbling block that I personally would have is just the basic notion of, if you're at 30 billion, you've got to go to 45 billion to get 50% out of it. And, you don't just add 15 billion, just because. To me, that's a big add. On the garbage that I buy, you take you take something like Grace that has been whacked down to 30 million after the CRL yesterday, and you look at it and you go, they got one product, there were no efficacy issues, that with the new FDA, that apparently doesn't mean much of anything going forward. But nonetheless, if you use a little bit of hope, and view it as a position that they don't have a functional problem, and then they basically come out and say, well, we're worried about the interface with the plastic bag. I mean, it's like, really? But that's the FDA at work. But you look at it and you kind of say, if it's a $300 million market, and they're currently trading at 30 million, and it's already gone through one rodeo, and the only thing they've got is a CRL for manufacturing and packaging issues. To me, it's an extremely high probability that they're going to get an okay at some point down the road. The big question mark is what's the timing. But it seems to me that if it's a $300 million indication, even if they're only doing 100 million, the company, if they get a third of the indication, the company's worth 300 million, which is 10 times what they're currently trading for. I mean, I'm okay waiting a year and a half for that.
Great point. And I made a move last month, sold AXSM, because I had a decent win, and I was trying to avoid the PDUFA by the end of this month regarding Alzheimer's agitation, because one of the branches of their trial failed. So I'm not comfortable holding through the PDUFA. But then I switched it with the Cogent Bio, which was my latest video. But I just realized I exchanged it with the stock that has 3 meetings with the FDA for the next year. So it's going to be exciting. And, Jack, wish me luck.
I like it.
Well,
I like it.
at least you don't have to be in the meeting, so your blood pressure is safe. Or safer.
Well, Jonathan, one thing that's really cool about today's meeting is I see a whole bunch of names on the screen here. I mean, the coffee is growing.
I like that. I see quite a few names as well. Blanche, I remember, who was under, a lot of people were under the username. You know how it is in chat, they give you a generic username and then figured how to
Blanche? Really? Is that Blanche?
So yeah, super. Go ahead. Sorry. Somebody was saying something. Oh. Well, anyway, I guess that's all from my end. I forget what Tom was saying, how that company could become a 10-bagger, 30 million to 300 million valuation. And that resonates with me in terms of the base hits over home runs too. Like when we bought Rare at 19, my base case is even if, just their gene therapy products this time around get approved and they get those 2 priority review vouchers. If Engelmann is just a decent product, maybe the stock is a double from here at least. And, if Engelmann hits it out of the park, that could be a really big indication. And the stock could be a multifold upside in the coming years if you have sales accelerate 2027. They were saying they would hit cash flow break even maybe by the end of the year or early 2028. I was a little bit skeptical whether that happens next year. But the market at $19 per share is valuing Rare as if they're going to keep having that high cash burn, if the pipeline's worth nothing. And so it's nice to be in those situations where sentiment can quickly change. And like Tom said, it follows the execution of the management team. If they're actually getting drugs approved, if there's sales being generated. So try to find those disconnects between valuation and what's actually happening under the hood. Aliska or anybody else, did you have something else you wanted to add?
I just wanted to say I will continue accumulating a name that is already in my top 5 position. That is LB Pharmaceuticals.
LBPH,
Jonathan,
right?
LBRX.
LPRX.
Yes, and that one, Jonathan has no catalyst until the second half of 27. So it's literally perhaps paint dry. But valuation EV is 600 million, and phase 2 asset already passed. So it's basically waiting for a phase 3. If so, then for schizophrenia, the valuation should be nowhere where things are today. So I don't mind accumulating at these valuation levels.
Like it. Thanks for sharing. You reminded me, thanks, Jose, what I was going to say before. Wilson reminded us that there's many ways to skin a cat in biotech, many ways to have success. There's swing trading. There's Tom's, black sheep. There's Jose with his high conviction long holds. And it reminds me of a friend of mine who's a fund manager too. And he does a few time arbitrage ideas, where he feels like they're very, very high probability of success. But the problem is the catalyst is maybe in a year or 2 years, but the valuation is so attractive, he just buys them and sits on them. Same thing goes for Fallen Angels, a company where it's a bait and switch where the first drug fails, but the second drug is actually very valuable. So at that moment when everybody's running for the exits, you're buying it because that second drug is actually the one that the story is going to shift to. So just a reminder that there's many ways to do well in biotech. And that's the fun thing of chat is I guess we're all learning a little bit about each other's strategies. Go ahead.
Sorry, on that note, maybe I'll just put my pitch out there. So
please.
Yeah, so it's actually kind of funny. People think I have, a lot of focus on SMIDs, which I do. But my number one pitch right now, going forward, is actually Novo. Yeah, and I'm not going to get details because that's beyond the scope of this stuff. But I did large cap biotech and big pharma for at least 5 years, and it's always a valuation story. It's always a valuation story. And when people say otherwise, it always comes down to the numbers. I'm not going to get the details here, but the numbers for Novo look very good. And then there's the upside of what happened today with the scripts for the Lilly oral drug not looking good. And I would tell you this right now, back when I did large cap a lot more, I was investing on a lot less info than I am now. So yeah, my number one idea right now, after all this time, is actually Novo. And I have a target of we'll see where it ends up. Right now, it's maybe mid-50s. But if I think about putting any money right now, which I'm not, but I am, that's where my money's going. I think this is one of the cleanest opportunities in big pharma out there right now. I think it's almost out there, almost I wouldn't say it's obvious, but it's there for anyone who wants to really kind of look into it, right? But your miles may vary, so that's all I'll say.
Hey, I appreciate it. That's one we'll have to. I did a blog post on Novo at the beginning of the oral Wegovy launch, saying the valuation. Obviously, I didn't do the kind of work on it you did, but quite interesting, especially in the contrast from what I've heard. I haven't looked into it, but the Lilly oral launch not going so well. Anyway, anybody else? Last chance before we call it close.
Maybe.
Go ahead.
I wanted to come back to what Tom was saying because it really resonated with me. I think I'm the black sheep type of gal. It's really hard for me to buy those over 10 billion names that are not selling any drug yet. Although, I kept being asked what is the next acquisition, and I'm like, well, I guess it's gonna be one of these revolution access CG's oncologies, but it's so hard for me to go there. I was a holder of Grace. So on Grace, maybe I wanted to ask, how do you feel with these names in terms of can they make it with their cash runway? And I couldn't even decide here if there was a massive dilution on Grace, whether the market would go up and down on that. So I really kind of want to keep holding it and be stubborn on it and be I'm going to be here, in a year and a half. But I'm trying to justify the long wait, knowing I think the cash runway is really here until Q1, Q2 2027, and then the company, let's say they get approved, but they're left with no money to commercialize. So how are you thinking about that?
Yeah, a couple of ways. I don't worry too much about the money in terms of the cash to make it happen, because the valuation is so asymmetrical that if they do get the approval, you're again, if it's a 200, $300 million TAM, and we're talking about a product that is basically a drug that's already been in use for 20, 30 years. It's the standard of care, and this is simply a different administration method. And so, to the extent that the data is good, I mean, I don't think that we're not going to the backside of the moon here. We're simply trying to put data out there that says if you stick a needle in somebody's arm versus giving them a cup of water and a pill, you have a much better outcome. That's not a big intellectual hurdle to climb, and so I think that the transition should be fairly doable, not horribly expensive. I would think for a small company like that, it could potentially make all kinds of sense to partner up with somebody that's already in those channels. Whether they do that or not, I don't know. But they're so small and they're spending so little money. I mean, what do they need to go another 6 months? $5 million bucks. And if you're sitting there with a product that is probably worth 200 or 300 million, finding $5 million to go another 6 months is probably a no-brainer. That's if the owner doesn't want to write a check. So I don't worry about that too much. I do. The thing I worry about, anybody who's looked at my three criteria, number one is risk, number two is timing, and number three is opportunity. And a lot of the time I will walk away from stuff purely on the timing basis. And this is really, to me, largely a timing question. I mean, surely there's some risk, no doubt about that. I think the opportunity is very substantial. The timing is a little bit unknown, and the biggest problem with timing is if you wait the year and a half, and for whatever reason you don't get the bump, to Jonathan's early point, the opportunity cost is troublesome. But I'm not going to make Grace a huge position. I think for me it's probably a 5% position. I tend to like stuff where I've got line of sight. I mean, when I met with Jonathan a month ago, I said to him over dinner, KPTI, Farm, is too stupid cheap right now. They've got a P3 coming out in the summer. It's a known timetable. They just had interesting data, not necessarily fantastic data, but viable data from the other P3, and they just got $40 million of institutional cash, and they went from $10 to $5, and the P3 is 90 days away. It's a no-brainer. And I came in, I loaded up KPTI, and it ran up to $9 in a month. I like those. Those are really nice. They make me feel smart. But they're holding Grace for a PDUFA makes me feel dumb. So on average over the last 2 weeks I'm just average. But I that's kind of how I look at it. I don't know if I answered your question or not. I know I droned on for a bit, but I think getting money for Grace isn't a big problem. The biggest issue is the timetable, and what could that money be doing if it were doing something else. So I'm not going to bet the ranch on Grace. I'm more interested, FBIOP started moving today, and I'm hoping that there's something behind that, because it's been kind of gridlocked in the 13s for a month or two, and all of a sudden it pops up and it's into the 14s. So I'm hoping that the drums are beating on FBIOP, and maybe next week we'll see something happen there. That would be nice.
Yeah.
I
So I might be a devil.
Go ahead.
I might be a little bit of a devil's advocate here on the company I like, just to get the conversation going. But I was wondering, obviously the opportunity cost is large with Grace, and I really was thinking, let's say this gets approved, I think I've seen too many times the fact that the product being better than what the doctors were using for 30 years doesn't mean it gets adopted in the next half year. So I guess I'm really worried there that this might not necessarily, while I believe the peak sell, and this is also how I model it, I'm slightly worried that it might take longer than a short time. And after that, like thinking, waiting for 12 to 18 months for the PDUFA to happen, then you get approved, then commercialize, like it might be like way more than 5 million and a massive, massive dilution for a company this size. And I'm just worried that that's gonna stress people and keep the price down, despite the fact that I really see the value. And
I think
that's
you could
why
be right. Yeah, no, I think you could be right.
But I'm on the edge there, right? Because I see the value, but I'm really worried about this scenario.
Well, what if they have a Trill type finance, when Trill was like $100 million and they had $100 million secondary, and sure, it did well, but imagine if you're in Grace and it does that, it's valued, what Tom said, 30 million now. I haven't looked at it, but imagine if they have a pipe or a secondary where that's 30 million as well. So you just got 100% diluted. I found out the hard way. If I'm trying to constantly rationalize a position in my head, that usually means I should not own a pro and a con to the way I approach commercial, like with Grace, would be if I would wait for them to get approved and look at those initial launch metrics and let those guide me whether or not I enter or I add to it. The con is that it could easily run without me, get bought out, or it does well before, in the pre-PDUFA run-up, et cetera. But especially with hospital formularies and things like that, where you just never know how long these things are going to take. Situations like SCPH, which we owned and it did get bought out, but people who owned it the first couple of years of their launch, they did poorly. And so just like OMER that I entered recently, I wasn't planning on entering it until they announced, it was 40-50% of the top 10 formularies, hospitals, they were already on formulary. Things like that, where I have that evidence. It doesn't mean I'm right, but it gives me hopefully a better chance at doing well. And so that's how I would approach something like Grace. Is I would require more evidence. Like management has to convince me with their execution to enter the stock. Like the burden of proof is on them, not on me convincing myself about the idea. If that makes sense.
Yeah.
Totally.
At the same time.
Go ahead.
Go ahead. Sorry.
Yeah, at the same time, I find it sometimes hard to be patient when you see like opportunity that feels so asymmetric and good value. And I need to really work on myself and be like, okay, let's wait for 9 months and let's see what happens. And then let's wait for another year and see the launch metrics if everything goes well.
I agree, totally. Grace is not going to be a big position for me. We talked earlier about does it have to be 5% to matter or above? I think with a company like Grace, I can have 2 or 3%, and because the upside is so great, if it triples down the road for whatever reason, 3% turns into almost a 10% gain across the whole portfolio. That's material. If you've got 3% and something goes up 20%, it's kind of a yawn. It's like, okay, that's nice, but didn't really do anything. So I think it's a question of the metrics. I won't probably hold too much in it if I see that some of the concerns that you're highlighting, which I think are very valid, are being covered, which is kind of, I don't mean to keep going back to Karyopharm, but that's kind of how I played Karyopharm. It was when things that were potential valid reasons for the stock to be depressed were taken off the table and the stock was still depressed, I grabbed some. And, when the data came out on the P3 and it wasn't fantastic, but it wasn't bad, and then they got $40 million of funding from a notable toot, and they've got another P3 coming in 90 days where most of the people are saying it has a fairly high probability of being good. And I'm looking at something that's trading at half of what it was trading a month ago. That to me is kind of a no-brainer setup. And you don't have to wait 1.5 years to find out. You wait 90 days. And as it turned out, we didn't have to wait 90 days. I cut the KPTI in half, and it's, it was 75% in a month. So I think Grace is a little bit far out there on the timing scale. I think there are other opportunities. For me, what happens is I cage match them. And if you do the risk and the timing and the opportunity, and you've got other things that on the same format are coming up better, then you maybe keep a couple percent in Grace and you put your money into the things that do better.
what resonates with me, what Tom was saying also is, I had to say this is how you waited with KPTI, as you said, for like more evidence that the story is going in the right direction. Like, oh, they don't have enough money. Oh, they just got 40 million or whatever directly from raw capital. Oh, we don't know about this indication. Okay, they reported positive data. So it's just like you're waiting for more and more evidence that the news is going in the right direction, that management is executing, and the share price was still at 5, and then you bought. I'm very, very old school with my habits, and one, as you guys know, is I have sticky notes taped on my laptop to help me not do stupid things. And one of them says, "Don't be a hero. Wait and cash patiently for the right opportunities." So, like when I'm shooting from the hip, and I'm like, "Oh, that looks really cool, like high opportunity," and maybe I'm not looking at risk appropriately, my first instinct is to buy it and do more of the thinking later. That reminds me, like Tom said, I'm going to wait for more evidence that management is actually executing, that the story is going in the right direction before I'm allowed to enter. Like Syndax, we were stalking it in the single digits at like $8 or $9, SNDX. And then only when we got the positive launch metrics for RevuForge for Niktimvo out of the gate, that's when I chose to enter. So for me, it's more about letting the management teams do the harder work, and then the share price and the valuation will follow. And I learned the hard way that when I rush into these setups ahead of time is when I do the most damage to my account, if that makes sense.
Totally. Yeah, I mean the other guiding principle here on this kind of a discussion for me, and again, it's nothing new. I've said it before. I approach biotechs from the standpoint that they are for dating; they're not for marrying. And, you know, Jonathan, you've been talking about rare, and you're saying rare could be really good. For me, rare has already been really good. I bought it when you put it up there at 19, and I got out of it at like 25 or whatever it ran up to. And the way I look at that is it's 20% in 30 days, which is 240% annualized, and I'm really good with that. And it was a great date. We went out for dinner, we had a good time, we had a bottle of Pinot Noir, and we're done. She flew away, and I'm in a different place. It was a great date, and I'm on to a new one.
Go ahead.
You know, it's just so I just wanted to make a quick contrarian pitch. So the company is Gossamer Bio, GOSS. So here's the pitches. So their phase 3 trial failed. They had a lot of so they had a lot of the patients were drawn from Latin America, and so if you listen to the phase 3 call, it sounded like there was, in particular, there was one. So there's one center in Latin America where the data was just like radically inconsistent, that showed like some huge placebo response versus everywhere else. So this is a very contrarian pitch. So the pitch is A, there's no downside from here, and then B, if they go back and audit and discover that, like, best case scenario is, you know, best case scenario would be something ridiculous like, oh, the center did everything right, but somehow when they reported the data, they just added the numbers up wrong, right? Or, you know, something.
Which ticker is this again?
GOSS.
Okay.
Goss,
got it.
Yeah. So, you know, so like, oh, we went back, we ordered the center, it turned out they added the numbers up wrong, and we reordered them, and we recompiled the data, and guess what? We reported before that we missed stat sig narrowly, but guess what? After recomputing the data, we now actually meet stat sig, and we're going to file an NDA. So I think the probability of that is relatively low, but the reason I just wanted to pitch it is that I think it's intriguing. Like, I have seen stuff like that happen before, and I think it's possible that Gossamer could find a way forward. Like, I mean, that would be the like absolute best case scenario, right? But the sort of in between scenarios where, you know, like basically the center just screwed up somehow, and then, you know, then maybe can they convince the FDA to accept the data, taking that center out? You know, like, who knows? But if that were the case, then if they can establish like some some issues at that center or whatever, maybe they can go to the FDA and maybe the FDA might approve the drug. But I think if that were the case, even if they just put out a press release, there's material upside on the stock, even if the FDA ultimately decided, as they would in all likelihood, that they still have to run another phase 3. So I just wanted to mention it. I had a speculative. It was like I don't think there's been a clinical trial that's failed this year that I've neglected to participate in. But so I had a small speculative position on Gossamer, and then I've actually doubled down. So now I own like 10 times the number of shares that I did before. Because the stock's gone down so much. So in the likely event that in the ultimate blue sky scenario, I would do extremely well because I own a ton of shares at this point. But I do think though it's just a very interesting risk reward. I really don't see downside in the stock here, and let me pull up the stock chart. But the stock could go back to whatever it was. So where was it going into the producer? So the stock could go from, the stock could essentially be a 10x here, right? The stock could literally be a 10x in the best case scenario. Again, I wouldn't attach a very high probability to that, but to me at least, you people talk about black sheep. Tom, you're buying 3-legged sheep. I'm buying 2-legged sheep. The sheep that I buy, you wouldn't even let it onto your farm, but that to my mind, I'm way more speculative than you guys. And
sorry, Mike, I say something here. So I have to say, I'm quite familiar with Gossamer. This,
yeah.
I'm telling you straight up, there is not appetite for this company, right? You're talking about a company that, they had their trial back in 20 or 21 or 2022. They failed. They did a Boskov thing. They missed that. And now, there's talk, right? Do you have to, for pH, do you have to do maybe does it have to be inhaled? Maybe a systemic drug in oral is not good enough, right? I just have to tell you, there's no appetite for this kind of company right now on the buy side, absolutely none. I'm telling you straight, there's no appetite.
No,
right. So
that's
yeah,
right?
Yeah. So no, absolutely. But I'm telling you on the institutional side, zero appetite for this type of stuff right now.
But isn't that why it's so low? I mean,
it is. Right?
If you take Mike's scenario, though, what happens if the data gets reworked and it actually gets a little bit of a green light? Does that change the appetite?
Sure. So let's go down that path. So let's say you go through the FDA. I've seen the FDA. I don't know how to tell you guys. In the last 2 years, right, they've voted down far more dicier stuff, and I'm sorry, for my just looking at that, I just do not think even the FDA
Gotcha.
from 2020 would go with this, right? I don't think they would, right? And you think about the dilution of stuff, and because the reality is when you get to this kind of capital size, everyone's competing with capital, there's no appetite for funding this type of company, right? So you're probably funding on very unfavorable returns. It doesn't look straight up.
I guess that's the beauty of what makes market. Mike is saying this is a very, very low probability event, but it's still possible. So it'll be interesting to see what happens.
I'm hearing it's a sheep on a pogo stick.
Yeah, no, for sure. It is. And that's exactly what it is. I don't like losing, so I would not.
Yeah. There was one guy, I'm forgetting who it was in chat, who was buying a lot of these shells, the ones that were, and then they ended up getting a good portion of those bought out for, not bought out, but for reverse mergers, and he did well in those too.
Yeah,
so
that's that's completely another point. So like, there's a lot of appetite for companies that have, a lot of cash. And I think Osmium fits that portfolio, right?
Mm-hmm.
A lot of private companies that are looking for a shell. Like, that very well could happen. No, completely.
Yeah.
Like,
I was just saying
that's
another upside scenario for Mike too.
That's completely. Yeah, that can happen. Yeah, I wouldn't depend on that, but yes, that completely acknowledged. Okay.
Oh, no.
Yeah.
Well,
folks, regrettably, I have to sign off. I've got to be somewhere.
I think that's all of us. You're good.
Yeah, I have to sleep as well. It's midnight here.
Well, at least in Vietnam, we know he's just getting started.
Oh yeah, just getting started. Yes.
Yeah.
All right, guys. Thanks for tuning in. Hope you all have a great weekend.
That was great. Thank you.
Thanks much. Bye.
Thank you very much.
Very great to meet you, Aliska.
Bye.
Yeah, very nice to meet you in person finally.
Hey, cheers. Yeah, it was about time.
Well, or online, but face to face somehow.
Yeah, it's the closest we get so far. But as Tom said, hopefully we'll do some more regional meetups later on too. I know we have quite a few people in Europe, and we have each continent. So in the meantime, cheers. It was fun.
Great. Thank you.